What I want to share with you today is the way that at PGGM, how we look at climate risk and how we implement it in our portfolio. Before I can start doing that, I want to give a short introduction about the PGGM Private Real Estate Fund in order to put things into perspective. Some characteristics of the Private Real Estate Fund. First of all, all of the investments are indirect. Why is this important? As you will see later on, if you want to do something with climate risk, you need information at the individual asset level. As an industry, we've not been adapting so much that the investors get asset level information. So that was a huge hurdle for us to take in order to make this possible. I will get back to that later on. It's a well-diversified portfolio across countries, across sectors, but also across managers. So we need a lot of cooperation from various managers in order to achieve what we have been doing, but also diversified across structures. So we've got joint ventures where we got 99% of the money in the structure. Makes it pretty easy to get all the information you need, but also some fund investments where all stake would be like 3% of the overall. So diversified, which just complicate getting the right information. The total size of the portfolio is approximately 14 billion across the globe. But because of the partial interest in a lot of the buildings, the underlying real estate value of this portfolio is over 160 billion in assets under management. Another characteristic, we'll get back to that, approximately 4,000 assets in countries across the globe for which you want to get a view on the climate-related risk. And the last characteristics I want to share with this audience today is that this fund has been outperforming its benchmark since inception, which is nice, proud of that, but of course we also want to maintain the outperformance of the portfolio. And in order to maintain the outperformance, we strongly believe we need to get a couple of factors right. First one is the easy part, the cycle. Figuring out what's going to happen with Brexit or the next elections in the US. How to incorporate that in the portfolio. So that's the cyclical part. However, a portfolio like ours, and there are more of those type of portfolios across the room today, is huge. It's also referred to as an oil tanker. So we can't ride the cycle all the time. We need to look forward. Also, an oil tanker will have a steering wheel, but in order to position it right, you need to look far into the future. So for this forward-looking, we also need to look at the various trends. These have been discussed today as well already, but some of the mega trends that we look at and incorporate in the portfolio, the first two are related to the population, so demographics, the size of the population, but also its composition will have strong implications for demand for real estate across the globe. Besides the demographics, another population-related trend is the urbanization that we see in countries across the globe. Japan is not known for its strong demographics. Still, we are investing in Japan, but not across the country, but only in Tokyo and Osaka, because those are the cities that are still growing. So even in markets with a less favorable demographic situation, the urbanization could still be there, and cities keep on growing. Another one, a very important big trend, it's huge, it's very broad. We can't figure out all of it yet, but technology. Of course, we've seen already the upcoming of e-commerce, what it has done since the GFC to the retail market, what we've seen in the industrial market, and the basis that's driven by technology. Going forward, some of these has been discussed already today. Jobs will be taken over partly by robotization, automation, etc. This will all have implications for real estate and the type of location that will be in demand. So that's also a factor we need to take into account. The last one, main topic for today, climate change. A huge, big trend, a lot of uncertainties, but a trend that could be too big to neglect. So even if there are a lot of uncertainties, it's something we want to take into account. Before I get further into the climate change, a short quote from Bill Gates. With all of these trends, often people overestimate its short-term impact and then are underwhelmed by the impact it has. But then if you look back in 10 years' time, then the world could have changed. And maybe even with some of these big trends, we need to wait longer than 10 years in order to see the full impact on real estate portfolios. But even if you have to wait that long, you can't neglect it and need to start thinking about it now already. So climate change is one of our big trends, and it's certainly not just us. It's a lot of interest in climate change. Yesterday before dinner, this was mentioned already on the last publication of the World Economic Forum, the Global Risk Landscape 2020. This one was released last week. You can't read the names in here, but I do hope you can see the colors. What the World Economic Forum does is on the x-axis you can see the likelihood of certain risk events happening, and on the y-axis the impact of it. So the further to the right top, the bigger the likelihood, the bigger the impact. And what you can see, despite not being able to read the names, a lot of green on the right top. Those are the environmental risks that we face across the globe. So these are the ones that are climate related, with big likelihood, but also big impact. The ones on the left bottom side are the economic ones. So there's much less concern from economic factors driving the risk landscape. The ones that are dominating are the environmental ones. This one is also quite interesting. The survey was done at the end of 2019. This is infectious diseases. Big impact, low likelihood. I think if this survey was done again, we might look at a slightly different picture, but this was done at the end of last year. Okay, so again, here we see the top 10 risk in terms of likelihood and the impact, and you can see a lot of green on this screen. So the risk factors coming from climate-related changes are strong, big likelihood, but also strong impact. Okay, so there's a lot of awareness about climate change. It's on top of mind. We've done this project. We see a lot of questions coming in, so there's a lot of interest in this subject. So the awareness is there. We see a lot of these type of graphs. I took the one for US temperature, but a lot of these graphs are out there that should raise the awareness for the subject. But having awareness doesn't improve your portfolio in the end. So what we have done is to roll up our sleeves and really start to get into action. How to take this big trend of climate change and how to implement it in our portfolio. And that's what I wanted to share with you today. Not to say that we have the secret recipe. If it was really secret, I wouldn't be sharing it today with this audience. But there are many ways to look at it, and I want to share how we approached it. Okay, so climate change can have impact on real estate portfolio through various ways. The first one would be transition risk. Dirk, the next speaker, will elaborate on that one, but that one is mostly driven by changes in legislation or preferences from tenants for particular type of buildings. The one that I will focus on is the physical risk. So those are really the ones that can damage land, damage portfolios, really that could potentially destroy locations. But something we always have to keep in mind is that real estate is also very specific. So there can always be asset level characteristics that decrease the risk level at individual building level. And that's always something that we need to take into account before jumping into any conclusions. I've got an example of that later on as well. Okay, so we acknowledge the risk of climate change on a portfolio, and we wanted to take action. And how could we take action? We needed to take a couple of steps. The first one was, as a global real estate investor, know where your assets are. And that means not just knowing where you have assets, but really where they are. And what I mean is that, yes, before we did know that we had, let's say, 7% in Japan and approximately half of that in Tokyo. But that doesn't help you in taking climate risk into account in your portfolio allocation. So what we needed to have is the real location of the assets. And that was not an easy step as a global investor because our managers were not used to giving that type of information to the investor at the asset level, but something we came over. So what we've done is to geocode all assets that we own across the globe. At the moment, we are in this building, and this particular building has a certain longitude, latitude, and that pinpoints it at a specific location on the globe, and that's what you need to have in order to make meaningful analysis of climate risk. So we did that for the 4,000 assets, and then you can start looking at maps like this. So every dot on this map represents one of our investments across the globe. In total, all the dots add up to the 160 billion GAV, and that's the overall real estate portfolio. So if you have this level of detail information on your portfolio, you would be able to add different layers to it in order to start assessing the risk of the portfolio. So that was step one. We thought would be a necessary step because meaningful analysis, you need to get down to the really precise geographic location. Next, we needed to have a partner that gives us the physical risk. So we had the layer with the allocation, but on top of that, we wanted to have the risk analysis for climate risk. We had a couple of requirements. We've got a global portfolio, so we wanted to have a provider of risk that also have a global focus. We didn't want to work with a patchwork of different consultants getting data together, trying to figure out a global risk landscape. That doesn't work. The other one was it also needed to be detailed, because it's nice to have something global, but climate-related risk like flooding is a very precise, very nitty-gritty. You need to get really down to the specific location in order to make a meaningful analysis. So it also had to be detailed. Of course, we wanted to work together with a reputable party. There's a lot of consultancies out there. Probably a lot of them are very good, but it's also a topic that has gained a lot of interest, so a lot of people want to bring something out on climate-related risk. We wanted to have only those factors that are based on the best models and scientific research. We needed a long-term partner, because this is going to be a very long-term project that we will be working on. I think I can work on it for the next 100 years and not be finished. And we wanted to have a party that's aligned. So not just somebody selling out data, but having sort of a skin in the game, the proper incentive to get this type of analysis right. A lot of the horizons that we're looking at would be like 2050, maybe even 2100. That's still a long time, but we wanted to have somebody that has this long-term view as well. For us, that meant working together with Munich Re. You might know them, the biggest, one of the biggest reinsurance companies across the globe. Their business can only exist because of their way of looking at climate-related risk. So for us, that was a natural partner, but there are more firms out there that could give this type of analysis. And so what have we done? This is the output of, for a particular building of the Munich Re model, in which they indicate for each position on the globe, so for every XY coordinate across the globe, they would be able to give this type of risk analysis for climate-related risk. I won't go through all of them, but what we've also done is that this is a climate-related risk analysis for real estate. Earthquake, volcanoes, tsunamis, great to know, potentially devastating for real estate, but not climate-related. So in our climate risk analysis, we excluded them from the way we look at it. And then also factors like hail and lightning. Munich Re also reinsures part of the wine harvest in France. Well, then you want to be worried about hail. As a real estate investor, we don't see hail yet as a really risk to our portfolio. So those are also factors that we excluded from the analysis. And then the 7 that you see on the right with the green marks, those are the ones that we really include in the risk analysis. So again, now we can see those same 4,000 assets across the globe, but now with a climate risk assessment. In this example, I took the composite for flooding risk, but all of those factors that I showed you earlier would be possible to map across the globe. So now you can also see, again, our portfolio, but also with the various risk levels that are attached to it. Okay, this is nice, good picture, but this doesn't really help yet, so I think when it starts to really become interesting, if you start zooming in. This is an example of our exposure in the greater Tokyo area, and then you can start seeing individual buildings with different risk profiles, and that's when you can start having discussions on individual buildings. So it's this level of detail that you really want. We don't want to be talking about the climate risk of Japan or the climate risk of Tokyo. No, we own assets across Tokyo, and it's that specific location that you want to have a view on. Okay, so nice pictures, right? I like maps a lot, and you can look at a lot of maps, but that also doesn't really improve the portfolio. So how do we see this changing the way that we operate? I think by having this type of information, we can make even better informed decisions. The climate-related risk will be there. You can neglect it, it won't disappear, or you can start making it part of the due diligence that we do. So from now on, we will be incorporating this type of analysis with new things we do, but also in the review of existing portfolios. So it's going to be, for example, input for the whole cell analysis among the other factors that we've always looked at, but it's an extension of the way of looking at the portfolio. Just to give an example of the type of conversation that we will be having, a certain manager could represent 2% of our assets under management, but represent 10% of the flooding risk of our overall portfolio. It's that type of overexposure to particular risk that we would like to discuss with the manager in order to see how we're going to do something about this. Earlier I said about the mitigants that could be in place at individual asset level. Example of those, this is a logistics warehouse, but it's Japan style, so it's 6 floors high. It's about 350,000 square meters, huge property. This property is in Osaka, in the Amagasaki area, and ranks very high on the flooding risk of our portfolio. However, if you look at this specific building, and this is a picture I took myself from an iPad from somebody else, so not the best picture, but you might be able to see a wall around this property. There's a seawall surrounding the whole property that's 6 meters above Tokyo Pile, the local measure for water height. The first floor starts at Tokyo Pile 4.55 meters. If you look back at current history, then the highest water that I've ever had was in 2018, typhoon number 21. Then the water came to 3.55 meters. And according to the local government, the highest water that can be ever expected would be 4.5 meters. So while this property does rank high on the risk of flooding, we do think there are some mitigants in place for this particular building that do limit the risk. Of course, you still have to think about a logistics building in an island of water is not really that attractive. So are also the roads well protected? Will still trucks be able to get to the building? It's that type of analysis that we still need to go through for the biggest risk part of our portfolio in order to take the right conclusions. But it's this type of analysis that does start to trigger this type of discussion, and I think that's something new for the portfolio. Okay, so this is what we've done so far. For the future, I think we will expand the partnership with Munich Re. I don't think this climate risk should be something specific for real estate. General equity markets, you can see now what's happening because of the coronavirus to supply chains, but climate-related events could also have big implications for supply chains, and how will that impact equity markets? So it's really not just a real estate type of subject. We will be expanding that, and also be increasing the forward-looking aspects of the analytics. So including the sea level rise would be like the latest addition that we add to the portfolio of risk factors that we include. Okay, that was the minutes that I had to introduce the topic. If you want more information, we've got a short paper on the subject that explains in more detail. If you would Google on my last name, PGGM and climate risk, then Google will show you the paper, so it's easy to find. Okay, thank you.
We'll have time for questions with Marta at the end. Now I'm very pleased to introduce Dirk Brown, who's going to tell us a bit more about carbon risk. Please come join us on stage. Thank you.
Okay, good morning, everyone. Thank you for attending and for inviting me. I hope you too also enjoyed Marta's presentation. I did, for sure. He gave us a very realistic view on the future and scenarios that we can end up in. But I do think it might not be the best end of a session because it's a bit grim and gloomy. Okay, so that's the reason why I've been invited. I can assure you that at the end of this presentation, I have good news. So, and to make it even better, I'm even going to hand out gifts to everyone in this room in 10 minutes. So it's something to look forward to. My title might not inspire, let's say, a lot of positivism, but I think I have a solution that we can use and start using from next week onwards, not to avoid everything that Martin talked about the climate risks that we will face, but maybe reduce them significantly. I don't need a lot of time because I'm sure you know a lot about the topics that are key in this project that I'm going to discuss. So we all know about climate change. We also know in this room that real estate plays a big part in that. We are part of the cause, but also part of the solution for the same reason. So we have a big carbon footprint. And that's also why a lot of policymakers have been looking at us as an industry to solve this. And one of the treaties that we know for sure is the Paris Treaty, and that is 5 years old. I guess we all have seen this picture. If you look at the picture, you might even think the problem has been solved. That's not why they're cheering. And it's 5 years old, to be honest. So a lot of what the policies in this picture imply got lost in translation to some extent. I'm pretty sure that if I would do an exam here today with people asking you what this really means for you, it will be hard, which I understand. But it's quite sincere because it's 5 years back, and to be honest, not a lot of momentum has been gained in the last 5 years with this treaty. But it's going to change, and that's what we're going to talk about. So what I would like to discuss is what does this, for instance, the Paris Treaty mean to you specifically, not just the industry as a whole, and also today. So not just in the long term, because in the long term we can be very patient, but what will be the impact of this for your portfolio and your assets in the midterm, in the short run. So I'm going to talk about climate policy implications, which are there. So I guess most of you know that in the Paris Treaty, there are two elements. One is we have a target set by 2030, we should have a reduction of greenhouse gases, the cause of climate change and global warming, of 40%, compared to 1990, that is. And that's a steep target. And we also know that if you look even beyond, in 2050, it should have been 80% reduction. But that's a long time away from now. It's 10 years, even 30 years, and most people that I know are not responding immediately to these kind of targets. But what you do also see is that there is a change in policymakers in how they're going to enforce their policy measures, and we are living in a data transparent era. So especially in the future, we will all be facing also the consequences of lagging behind the targets, not just as United Nations or as countries, but also as real estate professionals. And we have already seen some new shapes and forms of these enforcements. Things like tax penalties coming into real estate industries related to greenhouse gas emissions, or bans on rent, for instance, in some markets, that you no longer can rent out or lease out your property if you don't fulfill these new policy measures. And if it's not the policymakers, it might also be investors that will sanction us. So this is Larry Fink's New Year's letter to the CEOs. He talks about a fundamental reshaping of finance. And I think the most important element is the climate risk is investment risk. For BlackRock, that was new verbs. So we have heard about this, but this is becoming very serious to them as well. They say, well, I can't really invest as a company anymore in funds or investments if they don't have a very clear strategy on greenhouse gas reductions. I see some people making pictures. All my slides will be available after the presentation. If you want to make a picture of me, just go ahead. I have no reason why you would do that, but it's fine. Doesn't bother me at all. What does bother me is that climate risk will, in the real estate market, become really material for your property values. And that is very subtle at the beginning, at this moment, but it will become more significant and tangible in the future. And we call this and qualify this as an additional source of stranded asset risk. We have already stranded asset risk if you have a property that is no longer in demand. But one of the reasons why it could get out of fashion or obsolete is because it really fails to meet all the targets. And then you might face, for instance, tax penalties or a ban on rent, or just have a different taste of investors like BlackRock who don't want to invest in you anymore. And that will hit your value, of course, as a portfolio and reduce your return. This is the low point of my presentation, by the way. From now, it goes up. So what is the solution then, Dirk? Well, that's called the Carbon Risk Real Estate Monitor. So 2.5 years ago, I was invited by the European Commission, that is why the logo has been in my screen all the time, to work together with 5 other institutions in Europe to build this monitor. And these are the institutions, their logos at least, they come from across Europe, and we have been working and testing what we have been doing with a lot of people here in the audience, including Martin of PGGM. So what I want to do is first conceptually explain to you what this real estate monitor does. I want to show it to you, and then I have this happy end. Yeah. And I still have 7 minutes, so that's perfect. So here we go. First, what we do, actually, we do 4 steps. The monitor first translates more or less what you know is the long-term global target to something more national that you can relate to. Let's be clear, 40% is a target in 2030, but that will not be 40% for each European country. That will be split and divided, and it has been. And from a national target, we have to translate that into the real estate industry because we're only part of the economy as a total. And then within real estate, we're also going to translate that into the industry, the sector that you are active in. That could be retail or healthcare or offices. And all of these will have different targets. And we know these targets, but most of us don't. So we have tried to look at all these policies and make them available to you. And then we plot this on a vertical axis as greenhouse gas intensity of your property or your portfolio. And we take time on the horizontal axis. And we know, of course, that there are 2 dots. These are the global aims. And for your specific industry, we are looking for your dots, and then we're going to connect them. And that line that we will then show you will be called the policy pathway, which is important because that means from now until 2030, you know where you need to be in the meanwhile. And that becomes more relevant because this is something that will be monitored more closely than in the past. And that will affect your property portfolio. Policymakers will not just wait until 2030 to check whether we are all aligning with their policies. That will happen before that time. And this orange line in this graph will be the measure that they will benchmark you to. Then we start positioning you, if you like, at least in this monitor. We offer that opportunity. We can just, as an illustration, say that you at the moment have a lower greenhouse gas intensity than the max allowed by government. That was a little bit fast, but no, it's okay. So we can show you how long you have with the current standards of your properties or your portfolio before you hit the line of policy. And from that moment that you hit the line, you will be exposed to carbon-stranded asset risk. And if you don't do anything and you keep the status quo, which is quite common in real estate, then this will only get bigger over time. And that could mean that tax penalties will build up and stack up, or your tenants will walk away, but that could also be more severe. And that can depress, of course, your property value, and this could be a cause of that. So what we then do is we're going to calculate for you conveniently how long you have before you reach this moment. So in my example, that would be 7 more years. That's interesting because this will be different for everyone here in this room and for every asset, depending also of the industry and the market that you're in. And then we can also help you to maybe consider action. So if you know you have 7 more years, what could you do between now and 7 years to maybe avoid having this stranded asset risk in 8 years from now? And for this case, we have been simulating a retrofit of your property, including all the investment costs involved, but also how much more time you will have before you then will be exposed again to stranded asset risk, which is, of course, in this case, 13 more years, as an example. And this is the concept of the carbon risk real estate monitor. I see people are very excited. Then I'll just go on and show you how it looks in reality. So if you get started, you can actually, quite soon, you can find a tutorial video that explains the whole tool step by step. Quite easy. And then you need input, and input can come in 2 ways. You can do this manually. You can enter in everything yourself about the properties. The relevant aspects will be asked by the tool. Or if you're aligned with GRASP, it can be automated for you because your data is already there in their database, and you just click one button and everything will be entered into the CRAM tool, which allows you to do the carbon risk analysis. And the output could come in different ways. I show a diagram of a test that we did recently with a real portfolio, and this is only one of the assets in that portfolio. And here you see the line that I just shown you in the concept. And so the green line is, in this case, for an Austrian office building, the policy pathway. And at the moment, the property is fine, but it will not be fine in 2033 because then it will be exposed to stranded asset risk due to the carbon measures. And if you don't do anything, this will also be building up over time, as you can see. But we also have the retrofit simulation. We do it before 2033. We show you also at the right, you can see the numbers that come with this exercise. How much do you have to put in? What will be the gain? What will be the savings? But also what will be the impact on the property value? And if you don't believe it, the outcome, you can also always manually override it. If you don't like the discount rate that we used as a default, you can just change that. No problem. It's automated, but it's flexible. You can also have an output report on portfolio level. This is one of the things that we show. We have more than 25 of these types of graphs. At the beginning, you can see here that your portfolio is doing quite well. 90% of your assets in the portfolio are not exposed to stranded asset risk. But of course, if you don't act, that will build up over time. And at the end of this era, of 2050, everything is exposed to stranded asset risk. But we can also help you to adjust this graph by taking action and simulating how that will affect your portfolio. Given time, I will skip the next one and then just start summarizing before I start handing out gifts. So what do? Well, we help you to identify the carbon policies that are most relevant to you. I understand that nobody reads policy reports for a hobby, neither do we, but it's important that you know what is relevant to you. So that's what we translate. The first step is if you're in Romania doing retail, what is the relevant policies in Romania in retail? And that is what this first step entails. Then we will quantify your current position and look at the exposure that you will have in the future to stranded asset risk due to carbon. And if you like, we can also help you consider or even time a retrofit that aligns you with future policy implications. And it will shield you off of some of those stranded asset risks, which is nice, of course. You will have many questions, I think. Two could be, Dirk, where can I buy this marvelous tool of yours? And Dirk, how much will it cost? How much do I have to pay you? And of course, I'm available if you want to give me money, but the good news is, that's the Oprah Winfrey moment, all of you will start using the CREM tool for free. So that's really nice. Yeah. Actually, you already paid for it because European Union funded us, and I guess I should thank you, but let's not dwell on that. Unlike Oprah Winfrey, we didn't paste anything below your chair today because it's 2020. We put it on a website. The web address is crem.eu. You can go there. It's for free. You don't have to sign up. And from next Wednesday onwards, February 12th, the tool will be available for everyone, including the instructional video that I just shown you before. One last comment. It's important if you start playing around with this that you know that you should start working with this quite soon. Better soon than late, because your investors will also start using the CREM tool, because we also gave this to all people like BlackRock or PGGM. And it's always better that you do this before your investors do it, because otherwise they will start asking you questions about your stranded asset risk. So this tool will be perfect to do your homework sooner than late. Thank you for your attention.
Thank you. Oprah used to give away cars, but I guess with climate change, the moment has passed for that.
Electric cars.
Electric cars we could do, yeah. Before we start the Q&A, we've actually got a couple of polling questions for you on this topic. So if you can grab your phones, we'll just ask you a couple of questions. The first one is, Mike, whether your company has taken more initiatives around climate change in your work in the past 12 months. That doesn't matter what discipline you're in, just generally, are you looking at it more as an option? So if you could please vote now. Okay, that's quite a leap, I think, actually. And then the second question. When you're considering new projects, again, whatever you're doing, investing, developing, or designing, where is that in terms of the assessment? And I think that's interesting in terms of what Marta was talking about. Okay. Okay, close. So very high up on the priority, which I think we're starting to feel actually in the market, isn't it, when people talk about. And actually one of the first questions that came in from Marta was really about where in the process this is going to happen for those who work with you. I mean, are you going to require the people to provide asset level performance before you make an investment? When's that going to come for those who are working with PGGM?
We're still working on the process of incorporating across the whole portfolio, but we now already see in the investment committee, it's one of the factors that we report on. So still we look at the rental, growth outlook, yield expectations, you name it, all the metrics in there, but this is going to be one of those components that we will incorporate in our review of new investment opportunities. So it's there already, yeah.
It's there already. And both these tools look really at the downside risk, you know, what you should be doing to be defensive. I mean, Dirk, do you think that there's also opportunity there to, you know, can we use these to focus on opportunity as well?
Well, actually, we have had a lot of opportunity over the last 15 years. So, to be honest, I mean, I did a lot of research on green premia, which I think people know about green premia. But my impression, at least, is that people know about it, but they don't always have to act on it, because then you become a front runner. And green premia are not necessary if you already do well. And this indeed focuses a little bit more on loss and loss aversion, which in psychology we know that people respond more to.
Right.
Because you don't want to lose some of your return. If you think your return is fine, people listen to stories about green premia, but then they don't really change their portfolio adequately. So I think policymakers therefore also start now coming up with sanctions, because they are also running out of patience, which to some extent I can understand.
Sure. And someone just quickly asked if it's European or global.
It's global, but the tool is available only in Europe at the moment because it has been funded, but it will be extended later.
Yeah. Marta, just your perspective on this being defensive, do you think it's also something that you will look for a strategy in terms of opportunity where to invest in the future?
Of course, this works on both sides. So I think it's natural to start with those positions we have already with our increased risk profile. That's natural when looking at risk, but there are a lot of places across the globe that will have lower risk. I don't think it's priced at the moment, so it's a lot of awareness, but not incorporated in pricing, I think. So that could already give some opportunities. And going forward, I think real estate markets always benefited from scarcity, and if potentially somewhere in the future there's less available land and land currently occupied, a lot of economic activity at the seaside, very dense economic activity in regions that are at risk. If that's going to change, then there will be more scarcity of good supply, and that could be an opportunity.
Yeah. And someone's asked, you know, where would you continue to invest in real estate? I suppose that's, as you said, quite asset specific, quite city specific. Are there general areas that you now consider, well, not off the chart, but kind of, what are your thoughts on that at the moment?
Yeah, across the globe there are a couple of markets with increased risk profile. I think Miami is often mentioned as a city with a particular soil condition which makes it hard to get protection in place. Doesn't mean that we don't invest in Miami anymore. We do have exposure, but that would be like an area including other cities like Tokyo, which would be higher on the scrutiny level going forward. So thus far we have not ruled out any countries, cities or states, but there are these areas where you put more emphasis on this risk assessment.
Okay. And Dirk, you mentioned the Paris Agreement. Is it going to be regulation or something else that kind of brings more urgency to this situation for real estate?
Well, for sure it will be regulation, because it has been quite lenient in the past few years at least. So it has been more long-term targets, but I guess the tone is changing a bit. But this is also something that you could distinguish yourself from the mass. If I would be a fund manager, I could start using tools like Martin's analysis or the CREM tool, and then distinct yourself. We have seen that also with GRASP in the past. When they initiated, we now know a lot more about the real ambitions of real estate companies in the market, and also investors are taking that into account when they do stock selection. So you could become, let's say, a very transparent front runner, and I think that's a very positive thing.
Yeah. And actually someone's asked whether, should you sell now as the climate risk is not priced in? Are you going to, I suppose, use advantage of that kind of information to get out of assets where you think that risk will increase?
This is a long-term thing coming, but I don't think that we have to wait until these risks really materialize in order to see pricing impact. We've had this question, like, why do you share your model, your view with broader audiences? There's still enough time to act and to start incorporating in our portfolio. Yeah. But there will be a moment in time when it will be priced in, and I think there's still time to be on time.
Yeah. Okay. And thank you for your gift. It's open source, but do you think we need to do more as an industry together to kind of tackle this, that we can't have the proprietary data, that we need to work together in the same way that the Carbon Risk Project does?
Yes, of course, I think that would be marvelous if we would do that. I mean, that's also why I say it's a data transparent era. So it might be something that we don't, in the past we have been very well known for being a little bit protective of our data because we thought it was like a unique selling point that only we had and cherish. I think that illusion is going away a bit because, well, there are alternatives for getting your own private data. It doesn't need to come from your own drawer, of course, of the desk. Yeah. I think if we start relating to that, you can do so much more with the data that we have on real estate, and it can really help us make better decisions. So if we can see that, I think it's also a good pathway to start collaborating more. And I think GRASP is also a good example of that. So now nobody is really shocked by GRASP anymore or annoyed. We now have aligned with this. But in the beginning also, a lot of people were objecting to it.
Yeah, and someone's sort of asking really, how do you get valuers to start thinking about stranding risks and accelerated obsolescence because of climate change risks?
Yeah, it's a good question. It's hard because we have also had a hard discussion with the real estate appraiser community and communities to say, it's not exact science at the moment, not at their side, neither are ours. So what we did is we did a lot of theoretical research. So we looked at the literature and the studies that have been done empirically. So you know there have been studies on retrofits and value impact. So what a lot of appraisers will tell you, at least in some parts of Europe, is that when you look at the graph and you start in 2020 and you know that in 2027 you will have stranded asset risk, they say, well, I don't think it affects your property value now because we have to follow the market. So by the time it's 2027, I might take it into consideration. Typically, I think from a finance perspective, that is a little bit naive because, well, if we know there will be a ban on renting out in 2 years in the Netherlands, for instance, in the office market, if it's not a C level or better, I think it will affect your property value today. And that's also what we put in there. But how much should it be? I mean, I can make the calculation quite easily because I can factor in a vacancy that will come. So it's not a hard calculation, but how much of that needs to be in today, that has been a debate. And that's also discussed on the website, how we do this, very transparently.
Yes, a lot of people are asking exactly how you do that, but I think for the technical side, we'll get them to talk to you at lunchtime or it's on the website.
Sure.
Another aspect that people are look at is insurance. You know, they think that's covered my risks in the past, that will cover my risks in the future. Yeah. So how do you think that is going to be changing?
Yeah, I've had that comment before, like, why bother? Eh? You can insure this risk.
Yeah.
At the moment, you might be able to insure a risk, but there's also a reputation of a property. We've had comments for coming from Miami where the basement would be flooding, all cars destroyed. Maybe you get your insurance money back, but your Yelp review will shout out that this property is prone to flooding, so don't move in there. So there can be this insurance that's going to pay for new wall painting, for new cabinets, you name it. But if a company has seen this happening to its filings, for example, the paper filings, that cannot be restored. So insurance only goes a certain way. So that's one part. So at the moment already, I don't think that insurance will make up for those reputation risk of a property. Going forward, and that's why the insurance business is also clearly looking into this, part of their business model might be disappearing because there might be places where you don't want to insure anymore. In the US at the moment, still the FEMA, the governmental agency covers a lot of the flooding risk. In the end, no commercial company would be willing to take that risk. So there might be places going forward where you would not be able to get the insurance. For insurance businesses, it's sort of they can look forward to the review mirror because they only give 1 year insurance. And if the risk increases, they can increase the premium next year. But now they also start to look forward more, because there might be places in the globe where they don't want to be active anymore, where they've had a lot of business in the past.
Okay.
And there's not really an insurance policy that helps you for climate change, really, right?
No.
So I think what I try to say is if we would play with the tool and we would align with the policies, and that's something that has been signed off on behalf of all of us, then we can also reduce climate change to 1.5 degrees, which is quite important. It's vital. So of course then things can go wrong and you can get insurance for that. But if we fail to make targets, we will have a bigger problem than reinsurance claims, I guess. Yeah.
And so, someone's asked really about getting the data to do these tools. There's a lot of asset level data that you need. This is often with tenants and things like that. Are you struggling with that? Is that something that also needs to improve?
I think what we've been discussing on the legislation often goes about the requirements at building level in order to attract tenants. What we see, if you want to push forward to the building level with getting these type of metrics like the greenhouse gas emissions, smart meters could be an answer to that.
Okay.
But in a lot of markets, the tenant could just refuse you to put in place smart meters. So lately we've been trying to push forward with getting asset level information with respect to energy consumption. But across Europe, across the globe, we see issues just with the possibility of doing this, because tenants can refuse smart meters to be installed. I think that's also part of legislation that could help the industry go forward, because those that want to move fast will be at the moment held back by that type of legislation. And of course, it's important that these data are well protected. But you can also look at the data in an anonymized way and still get the information that you need, very detailed information on energy consumption, because that's in the end what you need in order to get to where you want to be. But that is a difficult process.
Yeah.
For the CREM tool, I don't see any data problems anymore. I think we solved this in the design because the tool is available to everyone for free. And at first instance, it's something for your own good. So if you want to use it, you just punch in your own data. It will not, let's say, be going out of the system, so that you learn from your own portfolio using the tool, which I think is a good trade-off, right? But if you refuse to use your data or share data, we have been testing this tool with the data of your investors. So a lot of funds, of course, have to report to them, and these investors would like to know about this as well. So in a way, always I think we will get the data that are needed. We are now not in the market to get everyone taking part. This is now available. That was the mission. And I hope people will start using it for their own benefit. Yeah. And then of course, you need data.
And there must be a long-term impact, though, on investments in terms of the higher operational costs, mitigation that you need to do for the building. What's your kind of outlook on that in terms of the industry having to deal with the risk-return profile of these assets?
Yeah, but these are not new things. Of course, these have always been in the framework, but now we make it a little bit more concrete. And we add an element, so we cluster this under stranded asset risk. Obviously, energy, operational costs, all these things, but also retrofits have always been part of the framework. But we now also explain that if you wait a little bit longer than average, there will be an additional consequence in the future that policymakers will take measures. And that kind of penalty will also need to be absorbed. And that has never been in the framework. All the other vocabulary has already been there. Yeah.
Someone's asking whether, specifically, would you turn down a tenant offering a premium rent who refuses to cooperate with or has a carbon negative profile? I think the world's changing a little bit around that, isn't it? So what would your view be on that?
It's difficult at the moment. We've also been discussing, would you have this company with a lot of servers blowing all the time, using a lot of energy, if that's going to push you above the line? And I don't think that we're there yet to make those decisions. In the end, it could be that this particular tenant is going to cost you so much in higher consumption that it doesn't work out. So the premium would disappear because of the payments you have to make somewhere else. I think that's something to find out, because otherwise that type of tenant that also will need to exist will be pushed around the globe in those areas where legislation is not that strict yet. I think we're seeing something like that in New York at the moment with the new pricing for energy consumption, where some of the data companies might move out because of their high energy consumption. Good question, still to be discussed.
Yeah, but I think attitudes are changing at a tenant level as well, so it'd be surprising to find those types of companies, you know.
Yeah, but there will always
be some.
Cold storage will use a lot of energy.
Sure.
And we need cold storage, but where to place them? Yeah.
Okay. And just finally, what's next, do you think, in terms of getting the industry and investors more involved in kind of looking at these risks?
Oh, well.
Going to your website?
Well, yeah, I hope next Wednesday will be a start.
Yeah.
So the tool will be available, and it also comes with all the reporting standards that are now common in the market.
Okay.
So the output that you can get can also be used for communication purposes, and I guess that will be the next step. Because if you're
demonstrating that you're taking
show
part.
it.
Yeah.
And if you don't show, people will ask about it in the long run. So it's better to do it yourself. And the format has been there, and it doesn't need to be a nasty surprise. You can be pleasantly surprised as well, and it just makes you think, which I think is always a good thing.
Yeah, and is that about starting conversations with your fund managers and stuff as well for you? Yeah.
Raising that awareness, we're looking into it. It's not going to overhaul the portfolio within the next year, for sure not, but it will be starting to impact the way we look at the portfolio and how it will grow further in the future.
Okay. Great. Well, thank you both for your contribution today. That's been really interesting. Please join me in thanking Martin and
You're very welcome.